Loans are like that tempting slice of cake when you're trying to cut sugar. They seem harmless at first, maybe even helpful, but too many bites and suddenly you're dealing with a sugar rush. Or worse, extra inches on your waistline. Loans aren't inherently evil, but they have this sneaky way of turning a small financial problem into a much bigger one. Today, I'm going to break it all down for you. Why loans can be dangerous, the rare moments they do make sense, and most importantly, what you should be doing instead to grow your wealth. Stick around because the last bit might completely change how you think about money. So first off, why do loans feel so appealing? It's simple. They promise instant gratification. Can't afford that new iPhone? No problem. Just charge it to your credit card. Need a new car but don't have $20,000 lying around? Here's a loan, easy peasy. The problem is that loans don't just take your money, they take your future income. Every dollar you owe is a dollar your future self can't spend on something more important. Think about that. Let's get into the numbers because numbers don't lie. Say you take out a $10,000 car loan with an interest rate of 10%. Over 5 years, you'll pay back a total of $12,500. That's $2,500 just gone. Money you worked hard for but handed over to a lender for the privilege of borrowing. And that's assuming you never miss a payment. Late fees and penalties, those can pile up fast. If you're already living paycheck to paycheck, any financial hiccup, like your car breaking down or losing your job, can turn a manageable loan into a complete nightmare. And that's just car loans. Let's talk about credit cards. Credit cards are the sneakiest type of loan because they don't feel like loans. You swipe and boom, you have the thing you wanted. But the average credit card interest rate is over 20%. If you carry a balance of $5,000 and only make minimum payments, it could take you more than 15 years to pay it off. And by the time you're done, you'll have paid thousands in interest. That's money you could have used for literally anything else. And payday loans? Don't even get me started. Some payday loans have APRs over 400%. That's not a loan, that's financial robbery. If you think credit cards are bad, payday loans are their evil twin. Avoid them the best you can. Loans in general are like an expensive band-aid. They'll cover up the problem temporarily, but the cost of borrowing can bleed you dry. If you've ever thought, I'll just borrow and pay it off later, trust me, I've been there. We've all been there. But that kind of thinking is keeping you broke. Now, I'm not saying loans are always bad. Sometimes borrowing money can make sense, but these situations are the exception, not the rule. Mortgages, for example, can be a smart move. Real estate tends to increase in value over time, so buying a home with a loan can be a form of forced savings. Just make sure your mortgage payment is something you can comfortably afford. Less than 30% of your monthly income is a good rule of thumb. Student loans are another case where borrowing might be worth it. But let's be clear, not all student loans are created equal. If you're borrowing $50,000 for a degree in computer science or nursing, that could pay off because those fields have strong job prospects. But borrowing $100,000 for a degree in something with limited career opportunities, that's a recipe for financial disaster. If you're going to take out student loans, do your homework. Research average salaries in your field and make sure the numbers add up. Or at least make sure that the degree is something that you're actually passionate about. I'm talking $100,000 worth of passion. So, what's the alternative? How do you avoid loans and still build the life you want? It starts with one simple but powerful habit: saving before you spend. Saving doesn't have to mean cutting out everything fun in your life. It's not about never buying your favorite latte again. It's about prioritizing your future self. Start with the basics. Open a high-yield savings account. These accounts pay better interest than your standard bank account. Think around 4% instead of basically nothing. It's not going to make you rich, but it's a solid place to park your money while you build your financial foundation. Your first goal should be an emergency fund. This is the most important financial cushion you'll ever have. Start small. $1,000 is a great goal to begin with. You can get there faster by cutting out unnecessary expenses. Cancel those subscriptions you don't use. Seriously, how many streaming services do you need? Sell stuff you don't use anymore. That old gaming console gathering dust? That could be $100 towards your emergency fund. Once you've hit $1,000, aim for 3 to 6 months worth of living expenses. This isn't just about peace of mind. This is your I don't need a loan fund. If your car breaks down or you lose your job, you'll be covered. And let me tell you, there's no better feeling than knowing you can handle life's curveballs without relying on a credit card. But saving alone won't make you wealthy. You need to grow your money, and that's where passive income comes in. This is the holy grail of wealth building. Passive income is money that comes in with little to no ongoing effort. It's not a get-rich-quick thing, but it's a smart way to grow your wealth over time. The first form of passive income I want to talk about is investing. Now, I know what you're thinking. Investing sounds risky or complicated, but it doesn't have to be. The biggest mistake people make with investing is waiting too long to start. The earlier you start, the more time compound interest has to work its magic. Here's an example. If you invest $100 a month starting at age 25 and earn an average return of 7%, you'll have about $170,000 by the time you're 60. If you wait until 35 to start, that drops to about $80,000. Time is your best friend when it comes to investing. The easiest way to get started is with retirement accounts, like a 401k or IRA. If your employer offers a 401k with a match, take it. That's free money. If you don't have access to a 401k, open a Roth IRA. This account lets your investments grow tax-free, which is a huge advantage over time. When it comes to picking investments, keep it simple. Index funds are a great choice. They're low cost and spread your money across a bunch of companies, so you're not putting all your eggs in one basket. Over time, index funds tend to outperform most actively managed investments. Another option is dividend-paying stocks. These are shares in companies that pay you a portion of their profits. The trick is to reinvest those dividends so your money compounds over time. Real estate is another type of investment worth looking into. Owning rental properties can make you consistent income, but it needs you to put in upfront cash and a lot of research. Make sure the rent covers your mortgage and other expenses. If you don't want to deal with tenants, think about investing in real estate investment trusts, which let you invest in real estate without owning physical properties. Digital products are another great source of passive income. If you're good at something, whether it's graphic design, photography, or teaching math, think about creating an online course, selling templates, or writing an ebook. These products take time to make, but once they're out there, they can keep earning money without much extra effort. And if you're willing to put in some work up front, content creation can be crazy profitable. Platforms like YouTube or blogging let you earn through ad revenue, sponsorships, and affiliate marketing. The key is to create valuable content that people actually want to engage with. It takes time, but once you build an audience, the income potential is huge. Now, here's the harsh truth that nobody wants to hear. I didn't want to hear about it either, but once I really took it in, it completely changed the way I think about money. Building wealth isn't really about money at all. It's about habits, discipline, and choices. It's about learning to delay gratification, saying no to something now so you can say yes to something better later. It's about constantly educating yourself, whether it's watching videos like this, reading books, or even just talking to friends who are on top of their finances. At the end of the day, building wealth isn't about luck or fancy degrees. It's about making smart, consistent choices with your money. Save before you spend, build an emergency fund, invest early and often, and set up multiple income streams so you're never relying on just one source of money. Loans might feel like an easy fix, but they're just putting future you in a financial headlock. Don't let that happen. Take control of your money today, and your future self will thank you. Have you ever regretted taking out a loan? Are there any other tips that you would add? Let me know in the comments. And if you found this helpful or interesting, make sure to like and subscribe for more videos like this.